In this lesson, I'm going to elaborate further on how to use Q points as a trend indicator. This is something that I have touched upon before, but now we're going to go deeper into the whole strategy and to see exactly how you can do this. So first, let me remind you what Q points really are. They are another way of saying that there is a confirmed swing in place. So Q points represent an area with the lowest risk and highest natural reward due to the amount of momentum that is observed at such turning points. Most of the money I've made was always at these kind of turning points. And if you know what to look out for, you will frequently find yourself in an explosive momentum that still happens these days, but usually only at areas of swing extremes. Now, supply and demand concept operates under the assumption that the originating areas of the swing will be reactive at least once after it gets retested. Many supply and demand traders tend to neglect and sometimes completely forego this basic rule, especially once they've traded supply and demand concept for a while. It sort of goes right out the window. I mentored quite a few people over the years. First, it was some of the junior traders at the prop trading companies that I worked for, and then later in Blatek, which is our own company. And we found that these traders start to heavily focus on scoring of the zones, and then they start to forget the location of the zones. Not every strong zone is valid for trading. And by including Q points in your supply and demand analysis, you will automatically exclude those zones that are not at the very least overlapping a Q point, and that will keep you out of trading the middles of swings. Attempting to trade the middles of swings without relying on day-to-day sentiment, such as reading market profile and then average daily ranges and price action and timing your trades intraday, it will ultimately lead to a lot of losses, a lot of guesswork. And guesswork is not how you become consistently profitable. Guesswork is what we're trying to avoid. Speculation based on facts versus guesswork based on your own feeling. They're obviously two very, very different things altogether. So Q points represent a price move from A to B that's been split into 4 equal parts, quartile points. But not every move from A to B will qualify for valid Q points. So there is a trigger point for the creation of the Q points. That trigger point is a pullback. But again, not just any pullback. The price must pull back over 50% where it came from in order for the quartile top and quartile bottom to become valid for trading. Some people throw back the Fibonacci retracement into my face, but you don't trade the 50% pullback. You're only using the pullback to instead trigger the top and bottom quartile. So here's a chart of, this was USD Mexican peso, one of my favorite things to trade these days. The price established the Q points, and then upon the first test of a Q low, the lower Q point, it created a very nice bullish engulfing. And then it also went all the way up to the Q point and to the supply that's inside the Q high, which is the top quartile. The Q points are an entire zone as well, but it really depends at exactly what happens at a Q point line. You could also look at it more as a key level rather than a zone, depending on what kind of price action you get. And this is the organic, creative nature of price movement. In trading, if you try to pinpoint just one price, like let's say 1.2915, and then the price starts to move around it and you get annoyed that your stop loss is getting hit because you haven't waited for the developing price action, then trading is probably not going to work for you. Trading any price needs to be looked at as a zone, as a little box. Any singular price should always be only used as a guide. So, for example, this Q low here, you can see it there. It could be that the price may just ever so slightly touch it before creating a reversal pattern. Then another time, it's going to go all the way deep into the Q low and then start creating a reversal pattern inside the Q point. But there is one slight distinction when it comes to Q point areas, which is a rule that can also be applied to supply and demand zones too. If the price indeed happens to test inside a Q low or a Q high, you can only determine that the price has indeed rejected the Q point area if the candlestick reversal pattern closes outside of the zone. Therefore, here's an example that is not necessarily valid for trading. Why? Because although this is a reversal pattern, the price hasn't yet left this Q low area. You can still trade it, usually with the help of market profile, but for the purposes of a swing, it's a little bit shady. On the other hand, if I go slightly forward in time, exactly the same chart sometime later, if you can see there's a bullish engulfing here that just leaves the Q low a little bit, and that's a good signal for reversal. You can then conclude that even if you are the best at reading candlestick reversal patterns and you're only doing naked trading, which means that you're trading without any indicators, you would have missed this little clue. And when it comes to price action, you need to have these hard rules in place. In this particular case, you have a great trading location, there's no doubt about it. And it's also at an originating demand area. Like, what else would you like? It's almost an ideal setup. But even when the inside bar happens, because the price didn't leave Q low, there was no strong movement in the opposite direction. So the price kind of just started meandering, going up and down, up and down. And in fact, this is a daily chart, so you would have had to wait the entire 6 days for your trade to move in your direction. Whereas if you just waited for a good price action pattern like this one, the bullish engulfing, the next day it brings you momentum, and then the next day. You can see why it's important to have this distinction between trading the reversals inside the Q point versus trading the reversals that have exited the Q point. Here's a little flow diagram to help you with the concept that I've just explained in here. So from this start, if you're not a technical person, the yellow areas represent a process that needs to happen before the next flow of execution happens. So there's no moving until you get the first condition. So price moves from A to B, and then you're basically checking whether there's a 50% pullback. If there is no pullback, there's no trading, or you keep waiting. If there is a 50% pullback, you have the Q high and Q low created. The Q points have triggered. But then you still have to wait some more. There's a lot of waiting around in trading. So you wait until the Q point has been reached, regardless of which Q point, Q low, Q high. So once you're there, you also need to wait for the reversal candlestick pattern. If there is no reversal candlestick pattern, there's no trading, you wait some more. But if you indeed have that candlestick reversal pattern staring you in the face from the charts and you stare back at it, you then have to also wonder whether the pattern has left the Q point or not. If the pattern has left the Q point, you are then free to trade. If the pattern has not left the Q point, there is no trading. Now that we've had this Q points revision, let's see how you would use them for trend direction. Now, for the purposes of reading which direction you need to base your trades on, this is where it all gets much simpler. So this is the new part, the upgraded part for 2019, something that has evolved from our own traders over the last few years. To read Q points as a trend indicator, your conditions are Q low recently rejected would mean an uptrend. Q high recently rejected would mean a downtrend. So if you're looking at a chart from a 4 hours and higher time frames, once you have the price action closing outside of a Q high or a Q low area, you will then read this as an early trend turn. If the price has recently rejected a Q low, it's an uptrend. If it's recently rejected a Q high, then it's a downtrend. And that is it. This system has worked really well for everyone at Blotech, including myself. So after a couple of years of kind of testing it out, it was finally time to upgrade the Market Stalker's method when it comes to trend reading. So let's look at this idea practically. Let's focus on the Q high rejection on this chart. So this is a bearish engulfing coming both from the supply area and from a Q high on the daily chart. Just by having this price action rejection pattern at a daily Q high, this will give you the direction for at least the next couple of days. And sure enough, you can see that the price carried on falling. And then it even gapped massively down after the weekend. But as a general rule, reading trend by using a daily Q point rejection is a very easy way to plan out your trades over the next couple of days. And you can also see whether your weekly trading plan is correct or not. It's factual, right? It's not guesswork. And this is why I say it's easier trading swing extremes. Middles of swings, they're messy, they're difficult to read. So for example, have a look at this chart. This was just a recent Aussie dollar chart. So pay attention to the daily Q high. Opens with a gap, eventually leaves the Q point, and then has like solid 3 days of massive moves. Very clean moves. So look at how the price action is formed whilst the price is still inside a Q point. It's choppy. Like they're going up, they're going down. Are we going up? We're not quite sure. Whereas as soon as the price left the Q point, you have these clear-cut black candles with a clear directional intention. And then after those first 3 days, the price starts to meander upwards. And, you know, yes, it kind of eventually reaches the opposing Q low, but it's choppy, it's uncomfortable, it's a difficult move. Imagine being in this trade and you're shorting it from like the middle, and then this starts to happen. It's like, it would test the psyche of the strongest trader. I don't know how people trade the middles, seriously, especially without market profile. This is why I prefer to trade the first couple of days as a swing, post Q point rejection when I can find it. And then I switch to intraday profile readings and setups for trades that kind of only last for about an hour, maybe up to 3 hours. But that's a flexibility that takes a lot of experience and practice. So I wouldn't really recommend it until you have this part of like swing trading nailed first. So the safest thing to do would be to play those areas of Q point rejections right after the pattern rejection happens. Those moves by far have the highest probability of moving in the new direction with considerable momentum, making your trades much easier. Now let's have a look at an issue that tends to confuse quite a lot of people. Dynamic Q points. Now Q points will be broken or created based on established swings. These swings will keep getting created and keep getting broken, and that's the beauty of Q points. So if you've already traded one swing extreme successfully, a newly formed Q point will give you an additional opportunity to trade the same area, but only if you wait for price pattern rejections. That's your guide. You cannot trade without them. Newer students or those who have just sort of flown through these lessons, they seem to be confused over the fact that Q points get broken and then created again sometime later with new moves as they're developing. So a very frequently asked question is, Q points keep getting broken. How can I trade them if this keeps happening? What am I doing wrong? Well, if a Q point is constantly invalidated, I can tell you right away that it's usually one of the following problems. You're using a low time frame, okay? So please switch to a daily Q point and then use those as your areas of reference. Or number two is that you're not even waiting for the rejection pattern before entering trades. Just like a supply and demand area can get obliterated, so can the Q point. Only if you have the rejection pattern at the side of the Q point, it's safe to trade it. But mainly people who complain about the Q points repainting, as they're calling it, it's just a case of staring at a Q points on like a 5-minute chart or even a 15-minute chart, expecting them to work out. If you're going to trade like that, you will need market profile, you will need average daily ranges, and you will also need the right time of day when that lower time frame Q point gets reached. It's not impossible to trade like that, but any levels on low time frames must have a confluence with either the value area edge or average daily ranges, or even just average session ranges. That would do as well. But without that additional statistical information, it's very, very tough to make that kind of trading work. So switch to a daily time frame, wait for the rejection pattern, and then you will have the correct usage of Q points. Another question that we get quite often is, when is a Q point invalidated? Well, let's think about this for a moment. So if a Q point is created when a price makes a move from A to B, creating a high and a low in any order, and if a price goes through a high and a low, a Q point is invalidated. So if the original high and a low is traded through, the ones that created the Q point in the first place, there will be no Q point. So there's your answer. And finally, the last frequently asked question in regards to Q points is, my chart doesn't have Q points. I've tried everything to switch them on with the black tick indicator, but no luck. If you cannot find any Q points on the chart, this can be an indication of a very strong trend. Usually these kind of trends are caused by some kind of a fundamental movement. So either an aggressive quantitative easing policy, for example. When you don't have any Q points, you have to use stuff like market profile distribution curves. You maybe even, like in super strong trends, you would use initial balance extensions to obtain a trade, because that would be the only option. So for example, you would then use buy stops and sell stops to just kind of get in. And it wouldn't be the most ideal thing, because you would have a poor trade location. So if you come across a choppy price action, you will be in trouble. And I know that when I say trading momentum, it's like, you just go in and buy stop. Sounds easy. Back in the 90s, when you had this crazy momentum and you would just position yourself anywhere, and if you were even half right, the momentum would reward the poor choice of a trade location. With S&P 500 move, the bull run for years, ultimately, if you could read a supply and demand chart even half well, it was fairly straightforward, because it was just one-sided. Identify demand, wait until it touched, go into a trade and wait. Take profit, rinse and repeat. It was just like that. You still needed like some skill to find the best location. So back then I actually had a strategy that used an exhaustion of an average daily range to the downside. So you're going opposite to whatever the trend is doing, again for that mean reversion trade. And then I would wait for a candlestick pattern to appear and I would enter a long trade. And that was it. If the average daily range exhaustion area happened to match up with the demand, that would be an even better thing. So I would actually increase my position sizing. So that's it for the Q points as trend. It's a pretty simple strategy, pretty simple system. You wait until the Q point is touched. You wait for the rejection to happen, and that's your new trend.